A mortgage loan is a type of financing used to purchase or refinance real estate, where the property itself serves as collateral. The collateral is what makes mortgages different from most other loans. If payments stop, the lender has a legal process to recover the property and sell it to repay the debt. Because a home purchase is typically the largest transaction most people ever make, mortgages are structured to spread the cost across a long period, commonly 15, 20, or 30 years, so the monthly payment becomes manageable relative to income. A mortgage payment is often described as having 4 parts: principal, interest, taxes, and insurance. Principal reduces the loan balance over time. Interest is the cost of borrowing charged on the remaining balance. Taxes refer to property taxes assessed by local governments. Insurance typically includes homeowners insurance and may also include mortgage insurance. Many lenders collect taxes and insurance monthly and hold them in an escrow account, paying those bills when they come due. This system helps ensure property taxes and homeowners coverage stay current, which protects both you and the lender. Even if your principal and interest payment is fixed, taxes and insurance can change over time, so the total payment can rise or fall. Mortgages come in different structures, but the biggest divide is between a fixed rate and adjustable rate loans. A fixed rate mortgage keeps the same interest rate for the life of the loan. The main advantage is predictability. Your principal and interest portion stays the same, which makes a long-term budgeting. The main advantage is predictability. Your principal and interest portion stays the same, which makes long-term budgeting easier. An adjustable rate mortgage, or ARM, usually begins with a lower introductory rate for a set period, often 5, 7, or 10 years. Then, the rate adjusts periodically based on an index plus a set margin. ARMs can be useful if you plan to move or refinance before the adjustment period begins, or if you need a lower payment early on. The risk is that the payment can rise later. ARMs include details like adjustment frequency and caps that limit how much the rate can increase at each adjustment and over the life of the loan. Understanding those caps matters because they determine the worst-case payment scenario. The loan term, meaning how long you have to repay, also impacts the monthly payment and total interest. A 30-year mortgage generally has a lower payment than a 15-year mortgage because the repayment is spread over more months. However, you typically pay more total interest with a longer term. A 15-year loan often has a slightly lower interest rate and builds equity faster, but the monthly payment can be significantly higher. Choosing the term is a balancing act between cash flow and long-term interest cost. Some borrowers choose a 30-year loan for flexibility and then make extra principal payments. Some borrowers choose a 30-year loan for flexibility and then make extra principal payments when possible. Others prefer the discipline and faster payoff of a shorter term. The down payment is the money you put towards the purchase up front. It reduces the amount you borrow and can improve the terms you qualify for. A larger down payment often leads to a lower monthly payment and may reduce the interest rate because the lender is taking less risk. In many conventional loans, putting down less than 20% typically means paying private mortgage insurance, or PMI, which protects the lender in case you default. PMI adds to the monthly cost, but can be removed once you reach a certain equity threshold, depending on the loan rules and how you request removal. Government-backed loans have their own mortgage insurance structures that may differ from PMI. Different mortgage programs exist to serve different borrower profiles. Conventional loans are offered by private lenders and are common for borrowers with solid credit and stable income. FHA loans are insured by the government and often have more flexible credit requirements and lower down payment options, making them attractive to first-time buyers or those rebuilding credit. VA loans are available to eligible veterans, service members, and some surviving spouses, and they can offer valuable benefits such as no down payment in many cases and no monthly mortgage insurance, although they may include an upfront fee. USDA loans are designed for certain rural and suburban areas and can offer low or zero down payment options for eligible borrowers with qualifying income. Each program comes with its own rules about property eligibility, documentation, fees, and allowable seller credits, so the best loan is the one that fits your situation and your long-term plan. When shopping for mortgages, you'll hear about the interest rate and the APR. The interest rate is the rate used to calculate the interest portion of your payment. APR, or annual percentage rate, is a broader measure that includes not only the interest rate, but also certain lender fees and costs spread out over time. APR can help compare loans that have different fee structures, but it's not perfect because it assumes you keep the loan for a certain period. A loan with a lower APR might still be less attractive if it requires high upfront costs and you plan to refinance or move soon. The right comparison looks at monthly payment, total closing costs, and how long you expect to keep the mortgage. Discount points are one common way closing costs and interest rates interact. A point is a fee you pay upfront to reduce the interest rate. Paying points is essentially prepaying interest to save money later. Whether that's a good deal depends on your break-even point. How many months it takes for the monthly savings to exceed the upfront cost. If you expect to keep the loan long enough, points can make sense. If you might sell or refinance earlier, you may never recover that cost. Qualifying for a mortgage involves more than just your income. Lenders evaluate your credit score, credit history, and overall reliability as a borrower. They look at your debt to income ratio, comparing monthly debt obligations to gross monthly income to see whether the new payment is affordable relative to your current obligations. They also consider employment stability, the consistency of income, and available assets for down payment and reserves. Reserves are the extra funds left over after closing that demonstrate you can handle unexpected expenses. A lender also evaluates the property through an appraisal, which determines whether the home is worth at least the purchase price or supports the loan amount. If an appraisal comes in low, the deal can require renegotiation, a larger down payment, or a different loan structure. The mortgage process often starts with pre-approval. Pre-approval typically involves submitting documents like pay stubs, tax returns, bank statements, and permission for a credit check. This gives you a more accurate picture of what you can afford and strengthens your offer in a competitive market. After you go under contract, the loan enters underwriting, where the lender verifies everything, orders the appraisal, checks title and insurance requirements, and confirms that the loan meets program guidelines. Closing is the final step, where you sign loan documents, pay closing costs, and the lender funds the mortgage. Closing costs are an important part of mortgage reality. They can include lender origination fees, appraisal fees, title search and title insurance, recording fees, escrow setup, prepaid homeowners insurance, and prepaid interest for the remainder of the month until the first payment date. In some transactions, the buyer negotiates for seller concessions to cover part of the closing costs, but that depends on market conditions and the rules of the loan program. It's wise to budget for both the down payment and closing costs so you don't end up short at the finish line. Mortgages are amortized loans, meaning each payment includes both interest and principal, but the proportions change over time. Early in the loan, interest makes up a larger share of the payment because the balance is highest. As you pay down the balance, the interest portion declines and the principal portion grows. This is where extra payments made early can have a powerful impact on total interest paid. Making additional principal payments can shorten the loan term and save interest, but you should ensure extra funds are applied to principal and confirm whether your loan has any prepayment penalties, which are less common today but still possible in certain products. Refinancing is replacing your current mortgage with a new one. People refinance to lower the rate, change the term, switch from an ARM to a fixed rate, remove mortgage insurance, or access equity with a cash-out refinance. Refinancing has costs, so it should be evaluated the same way as points, through a break-even analysis. If the savings outweigh the costs within the time you plan to keep the loan, it may be worth it. If you expect to move soon, refinancing may not make financial sense. A mortgage is both a financial tool and a long-term commitment. The best mortgage isn't necessarily the largest you can qualify for. It's the one that fits your lifestyle, leaves room for savings and emergencies, and doesn't force you into constant financial stress. A strong home buying plan usually includes a comfortable payment target, an emergency fund for maintenance and repairs, and a clear understanding of how the loan's terms could change over time.